Okay, good afternoon and welcome to FSM1 webinar on the topic Singapore rates or known as REIT is investable in a rising interest environment. Okay, my name is Mark and I'm a client investment specialist from FSM1 station in Johor Bahru office. First of all, I would like to thank all the participants who registered and joined this Wednesday afternoon webinar. We have invited the Chief Executive Officer of Equities Tracker Holdings Berhad to present on today's topic. Okay, we hope this section will be a benefit session for you. During the webinar, feel free to drop your question at a Q&A tab to let our speaker address the question that you may have. Okay, with that, allow me to introduce our speaker, Mr. Alvin Wong, Chief Executive Officer of Equity Tracker Holdings Berhad. Okay, Mr. Alvin Wong is a CEO of the Equities Tracking Holding Berhad, a company listed in Bursa, Malaysia, and he also a creator of the current version of equitytracker.com research portal. He is also a co-author of the equitytracker.com value investing and portfolio educational series, which is a structured course on value investing in the region. equitytracker.com currently provide a fundamental data of Malaysian, Singapore, Australian listed companies to international data aggregators and investment banks and also brokerages. Okay, Alvin served on a board of ASX listed company and is experienced in fundraising. Alvin is currently involved in tracking undervalued listed companies in Malaysia, Singapore, and Australia, and lectures extensively on stocks and crypto investing. Alvin believes in value investing and a proper portfolio management technique for long-term wealth creations. So he's graduated from University of Western Australia and has a degree in accounting and finance, plus a graduate diploma in information technology. So without further ado, let's welcome Mr. Alvin. Mr. Alvin, the floor is yours.
Very glad to be here, excited to be here. So today, I understand the presentation is 45 minutes, so I do have quite a fair bit of slides to go through, so I will try my best to get through that. Now, of course, if you guys have any questions at any point, just please post it, and then we'll leave it to the Q&A session. I think today's topic, I'm just gonna share my slides now. I think today's topic is really kind of on everyone's mind right now. Inflation, we're seeing headline inflation, we're seeing interest rates going up. I think just a couple of days ago, if you're talking about Singapore, the mortgage rates just went up as well, if you're based in Singapore. So I think it's quite a, what I hope to achieve with this webinar is not just focus on REITs, but really let's look at what's causing inflation. Is inflation likely to go out of control, spiral out of control? Will interest rates continue to rise? Will US dollar continue to strengthen, right? And perhaps to answer some of these questions, we really need to look at it from the root cause, right? What is the root cause? So of course, what I will be presenting, it's very much my personal view. So it's a disclaimer. So we won't be doing any buy, sell, hold calls. So if you're going to be asking me what to buy, what to sell, I won't be able to answer that, unfortunately. All right. But I do want to let's look at some of the headlines. So if you look at these are fairly recent headlines. I think 8.5% has struck out in March, especially for a lot of investors. I think globally, if you look at global prices, not just we talk about crypto assets, we talk about stocks as well. It's actually come down quite a fair bit from its all-time high about 6 months ago. Of course, the headline that the press has been feeding us is inflation. Right. Okay. Now let's look at inflation. It is right. Inflation rate has gone up. And of course, when they measure 8.5%, we have to remember they are measuring the scale of March 2022 versus March 2021. The growth rate now. So if you remember 2020 and 2021, where I think most of the world was under lockdown in 2020. Generally, 2021 was maybe worse, right? But lockdowns were still happening. So fairly manageable inflation rates during that period. Now, of course, now that we've had 2 years of pent-up demand, and I think most economies are open except maybe for China, we are bound to see this pent-up demand and and a supply shortage at this point in time will bound to drive prices up naturally, right? When you compare inflation rate in the pandemic period and a post-pandemic or endemic period. Now, so if you look at this, I know some of you guys are thinking, is inflation rate actually driven by oil prices going up, right? So, if you're fortunate to live in Malaysia, we've been fairly well insulated from this inflation rate. If for those of you who are still in Malaysia, your fuel is RON 95 is 2.05. It's not changed throughout this whole period. The real price should be $6 or $7, right? That's what the real price should be. So you can see even in Malaysia, if we look at some of the inflation rates later, that we are still come out at one of the lowest. So even excluding energy, so if we look at this chart here, even excluding energy, food and even excluding energy, you're going to realize that it is still high, right? So we're looking at about 6%, right? Now, let's kind of look at why and some of this has happened, right? So 6.5%. So you can see UK inflation rate is also at an all-time high, okay? But in Malaysia, for those of you who are Malaysian, they're logging in, you're thinking, why it's only 2.2%? It's a little bit strange, right? So one of the reasons why, if you look at even in Singapore, our next door neighbor, it's 5.4%. So if you kind of summarize it, right, why is kind of Malaysia the lowest, right? So in fact, with the GST implementation or increase in GST rate for Singaporeans, in fact, inflation is expected to go up, right? Or one-time inflation rate. Now, so if you kind of really look at it, Malaysia's at the lowest. One of the main reasons is that when economies measure CPI, they measure it on a basket of goods and services, right? And the benchmark is always starts at 100. So in the case for the US, it's based on the 1980 basket that they have adjusted. So if you kind of measure it, if you look at the baskets of goods and services in the Malaysian context, a lot of it is actually either price controlled or there's a subsidy given, right? So in the case of fuel, it's subsidized. In the case of very simple staple like rice, sugar, right, they are price control, or poultry or anything protein related, right? So you can see that's why the inflation rate is still fairly manageable, right? And we haven't yet had to increase our interest rates. But globally, I think it is to be expected that all countries will be increasing interest rates this year, maybe likely into the next year as well to stabilize things, right? But I want to share with you very quickly why they actually need to increase interest rates, right? So one of the main causes, right, or one of the main pushes for inflation really is QE, known as quantitative easing, right? It's a very nice word of money printing. But I'm going to speak very layman, right? So the central banks during the pandemic have just created a lot of money, right? Now let's look at the time period. So if you look at year 2000, there was roughly about 4.6 trillion US dollars that have been printed in January 2000. Now, so if you look fast forward 20 years later, that number has increased roughly 3 times. So in 20 years, that number has increased 3 times. So the absolute amount is $10 trillion, right? But if you look at what has happened during the pandemic, to actually stave off a very, very bad recession, what central bankers have actually resorted to do was actually create more money. Now, this term was highly popularized by Ben Bernanke, the ex-Federal Reserve chairman, where he called it helicopter money. Well, what are those helicopter money? Just fly a helicopter and then you drop money, right? And that's precisely what the central bankers did during the COVID pandemic. They literally issued out prepaid Visa debit cards to their tax-paying citizens of about $2,000 US, and it really just flooded the market with liquidity. Now, when doing that, of course, there are pros and cons. So one of the pros was immediately to stave off any sort of major shock recession, right? Because the whole world was going through a pandemic. Now we're dealing with the after effects. So the after effects is definitely inflation. Now, if you look at the rate of creation of money in that 2-year period, it's actually quite staggering. So if you look at it from 15 trillion to actually, this is Jan 2020, it was 21 trillion, right? So actually we're now closer to 22 trillion. So if you look at it, $7 trillion in a 2-year period. Now that is quite staggering compared to, that's about half of what we did in 20 years in 2 years, right? Just to give you some perspective. Now, the other way of looking at this money creation or the ample creation of money, let's look at this. Let's look at this scenario here. Now, this whole idea of quantitative easing or printing of money, yes, it is a short-term fix. Sometimes, you know, in 2008, when we had the too big to fail moment, you notice that in that period in 2008, 2009, the Federal Reserve Chairman or Federal Reserve back then actually created about $1.3 trillion in 2 years now. So they actually doubled the total amount of US dollars, right? That have been created. Now we have to remember now that, you know, almost 70% of the world's US currency, that US dollar, is actually traded outside of the US. Not so much internally, right? Because most of the trade is denominated in US dollars. Most commodity prices are determined in US dollars as well. So if you look at this period, 2008 to 2009, right, they doubled the amount of money in the system, right? Now, following that, you realize that Ben Bernanke, who was a Federal Reserve Chairman back then, he kept continuing to print, right, or create money. This is the Federal Reserve balance sheet, right? So what they did was they call it bond buying, which means that the Federal Reserve will buy bonds, right? That means buy bonds. That means when they hold a bond, they will issue money, right? So what they have on their balance sheet are all these bonds, right? Now, of course, in the US, they have this massive advantage where their loans technically do not really need to be paid off because they can just literally create more money to print money, right? To settle their own loans. So they are unique in the sense that they are the only country in the world that can get away with this, right? Let's put it that way. They can get away with this, right? Not the only country that can do this, but the only country that can get away with it. Now, so what happened was when we had a change of hands of Federal Reserve, which was Janet Yellen. You notice that over from 2014 to 2018, about that period, it was almost no growth in QE. That means they kept it fairly stable, right? In fact, what Janet Yellen did was actually try to reverse a lot of what Ben Bernanke did, was create so much money out of thin air for nothing, right? So what she did manage to do during this period was actually over a 2-3 year period. You can realize just before COVID was went from 4.5 trillion to 3.7 trillion. Now, during that period, if you guys were in the stock market, you still remember, things were already starting to slow down. And this was not by a lot. They actually only reduced the money supply by about 700 or 3 points. So we're looking at about 800 billion, right, over a 2-year period. And even then, we already felt those effects, and there was no pandemic. There was really nothing going on there, right? You can start to see that interest rates were high or higher, but the economy started slowing down, right? Your GDP growth becomes lower. So tweaking this just by a little bit actually has fairly devastating effects. Now, if you tweak this very fast, it's going to have very serious consequences. If you tweak this very slowly, we will have a slower effect, right? You know, it's like a frog in a pot of cold water, and you're boiling that water, right? That's really what it is. Now, subsequently, you noticed actually just pre-pandemic, they knew there was a slowdown, and actually they couldn't. So they moved 3.7 back to 4.1, which was very close to where Ben Bernanke kind of left it. Now, of course, after the pandemic, you can see that the Federal Reserve has actually increased almost more than, you know, they actually more than doubled their balance sheet in bond buying, aggressive bond buying. That means keep creating money, right? Of almost $4 trillion. So, you know, they created $4 trillion in a period of 2 years, right? Now that is a very, very massive amount. So, you know, I've been asked quite a few questions like, so in this case, right, all stocks are falling now. All the central bankers are saying we should increase interest rates. Is this likely to solve the issue? My short answer is unlikely in the interim period to actually do this, right? If they really wanted to do it, they really need to really drastic cuts. When we move from 8.9, say we even move to 6 trillion in a short period of time, that will actually have extremely devastating consequences to the economy, right? So very recently, Paul Tudor Jones, a billionaire hedge fund manager, said that if he was Jerome Powell today, who was actually the chairman of the Federal Reserve, that he would resign because they're stuck in a very, very difficult place. So on one hand, if he continues to create money, it's good for the economy, but the consequence is high inflation, right? Now, if you don't create more money, then you might stall the recovery period. Now, if you actually even reduce the liquidity in the market, you might actually even trigger a second recession, right? So I think it's quite unlikely, this is my personal view, I think it's quite unlikely that the third will happen, that they're going to reduce it so drastically, remove liquidity from the market. I think what has happened is that the signals that they have sent that they will continue to increase interest rates over this period of time has already signaled free market forces to now move back into the US dollar and reduce liquidity. That means self-adjust. And that's why you're seeing that the stock market has come down, because more people are now moving into the US dollar, and the US dollar has actually strengthened over time. So if in Malaysia, the ringgit did not really weaken, the US dollar strengthened because of this effect. So free market forces are moving. Of course, they have signaled even more higher interest rates, and we will talk about interest rates in a short while, right? So I think the tricky thing about looking at inflation and looking at the amount of money that's been created during this short period of time is that it's almost a one-way street. You can't create money and then just suddenly pull it back from the market. So you can put it into the market, but you can't very quickly absorb it really back without extremely unintended consequences, right? So it's almost like a one-way street. It's like minimum wage, right? You can now the Malaysian government is pushing for 1,005 minimum wage. I think it's coming into effect 1st of May. You can't go back next year and say, let's push minimum wages down to 1,002, right? That's not going to happen. So this is a likely scenario. So if we look at what the Federal Reserve is doing, it's likely that yes, they will increase interest rate. I think that is already for sure, but we're unlikely to see a massive drop in this in the liquidity. Unlikely to see massive drop, but probably more left to free market forces. Now, we have to remember that the Fed Reserve is talking about inflation rate, not inflation. Two very different things. Why do I say rate? Rate is rate of change, right? So if you are measuring during a pandemic period and current year prices, you will always get very high inflation rate. Now, if we talk about next year versus last year, if you talk about next year when they look at rates versus this year, very likely these rates will come down. Very, very high chance that it will come down, right? And then everyone's hunky-dory, right? But we cannot forget there's still an extra $4 trillion that was created during this period that is unlikely to be reduced in a very short period of time, right? So if you look at even inflation, if you look at this graph here, you're gonna really notice. I'm just gonna annotate here. This is a very long-term graph. This until the 1950s. It's it's quite simple. You see, every time there is an increase in money supply, almost guaranteed that lag effect. You can see directly actually inflation rate is low, right? You're gonna almost see. Let me just change a different color here. That you're actually gonna see this go up, which is what we're seeing today, right? And then it comes back down again, right? We always see it's almost a lag effect. So then you increase money supply again. This goes up again, almost very quickly. As quickly as it goes up, it comes back down as well. Now, so where we are now is actually we are in quite a similar situation, but where it maybe where we maybe have not seen before really was is really this part here. We've not seen money supply grow at 25% per annum in the whole history of the US dollar. We've not seen it in the last 100 years. It's not now. You can see that this has come down, but we have to understand this is 25% growth rate. This is 10% growth rate. That means the rate has slowed, but it doesn't mean they have reduced money supply, right? In fact, it's gone up. So it's 10% above 25%. Now, of course, now what we're seeing is this part here, right? So maybe it might go up. And just as quickly as it goes up, it's going to come back down very quickly as well, right? So if you look at this, because this has a laggard effect, right? In fact, we did cover this in some of our sessions last year when we said that this was, it's going to be very high. Last year, we had no idea about inflation, but you can always say it has a laggard effect, okay? And we're now, so really, I think to most investors, if you're invested today, and if you are feeling a bit emotional or panicky, I won't do that just yet, because I think what we're seeing today are a lot more level prices, understanding that the liquidity is still in the market, right? So, but there's a lot of fear, but the liquidity is still there. So, which means that this liquidity will eventually have to find assets again, right? So to me, it's only a temporary departure, right? Now, at the crux of the matter, we did talk about why inflation rate's high, but how is it causing inflation rate to go up? And this is how we're going to relate this to REITs, right? One of the biggest things that you've seen over the last couple of years is commodity prices really soaring through the roof, right? You've not seen commodity prices where they are today, right? If you look at the Malaysian CPO price, we are 3 times higher than what the average is for the last 10 years. You look at iron ore, you look at copper, you look at coal, you look at any base commodity today, metals, they are high. So the last time they were this high was probably back in 2004 to 2009. Well, I won't say 2009, but maybe shorter period. But during this 2000 and 2006 period, if you can see this here, right? So this period of time, we have to understand why metals actually went up. Now, one of the reasons why metals went up during a very short period of time was very simple. Was because China had a policy. Remember, this was 2000, right after the Sydney Olympics. They were building up to 2008, the Beijing Olympics, right? So there was a lot of infrastructure that needed to be built. So during this very short period of time, to maintain GDP growth for China, they had a very simple strategy. It was really a lot of infrastructure projects. Now, after this was over, that demand just dropped completely when China moved its next policy to be more consumer-centric. So whenever we have very high prices in commodity prices in a short period of time, we must understand whether it's sustainable or not. In this case, for base metals back then, it was not sustainable because it was only had one leg to stand on. So we're going to talk about this in a bit. See my time, okay? So the other reason here is also very important to understand is that over the last 15 years, there have been a lot of focus into the new economy or technology-based companies, right? So the technology-based companies actually have, because they are sexier, they've attracted a lot more capital than the traditional businesses, right? You can see it's a massive laggard. So under investment in commodities, right? Really, if you look at the growth of supply in commodities over the last 10 years or 15 years, is nothing, right? Not even close to where the tech space has been, which means if there is increase in demand overnight, there's likely going to be a shortage, right? Now, the third thing that is for commodities is that you can't, it's a physical limitation, right? Commodity, you cannot just bump up supply when you want to. You cannot just print money when you want to. You cannot just create oil when you want to. You cannot just create iron ore when you want to, right? Unfortunately, if you look at a lot of the base metals, it takes anywhere between 4 years to 10 years, right, to get into production. And I'm not even talking about oil, right? If you talk about crops, for example, at least a year or 2 years, right? If you talk about palm oil, for example, you must have planted it 4 or 5 years ago to actually bear any fruit today. So these are physical limitations that you can't force it in the short term. Now, of course, we have also the Ukraine and Russian war. Every time we have a war, you notice that oil prices will go up. Of course, it's come down of recent days because of the strengthening of the US dollar, and that's to be expected. Now, so really we're trying to figure out, why is it that commodity prices are high right now? And the question is, will it remain high? In my personal opinion, likely would remain high for at least the next 12 months to 24 months, right? If we look at very basic food, right? If you talk about inflation, food is actually one of the staples in your CPI basket. You're actually going to see that Russia and Ukraine both actually produce a lot of wheat, right? Now, they're not the largest wheat producers in the world, but they are the largest exporters, right? Russia is the largest exporter. So, with all these sanctions going on, but I don't think they have actually sanctioned food, right? Because that is a basic necessity. However, Ukraine being an export of wheat, which is quite substantial, right? It's 8.91%. So they've missed their planting season. Unlikely there'll be any or very minimal wheat exports from Ukraine this year. Maybe not even next year, right? So there's going to be some shortages that we're going to be finding. The other thing is also vegetable oils as well, because Ukraine is also a very large exporter of sunflower oil as well. So you're going to really notice that the substitutes like soybean and palm oil will go up in price because there's now a certain shortage, right? So in summary, if you look at the commodity prices, these are the 4 factors. So compare this to 2001 to 2005 or 6, right? Where base metal prices, commodity prices were going up. It only had 1 leg. Right now, commodity prices actually have 4 legs. So you have the QE factor, which they are trying. Now they're trying to do the reverse, which is QT, quantitative tightening, right? They're trying to increase interest rates. So that's going to be dealt with, right? But even if you deal with that, you still need to deal with 2, 3, and 4, right? Now, if you look at 2 and 3, it's not solvable immediately. Even if you suddenly pour investments in the commodities today, base commodities today, you can't produce them today. 4 years later, yes, right? Because of number 3, right? And of course, number 4, we don't know how this will end, but we know at some point it should end. And this will resolve itself, but we're still looking at the next 12 to 24 months. So when you look at why commodities, right, are going to be high for a while, this will then move into the REIT sector, right? Because if you look at REITs, for example, REITs are, I call REITs what they call collateralized fixed income instruments. So you would invest in REITs if you're an investor looking for constant returns, right? Higher than what you're going to get in your fixed deposit rates. And I'm going to share some slides in a short while. So you will see all these very scary headlines, but maybe hopefully whatever I presented will calm some of your nerves, because it will happen, expected to happen. But I think it's only a temporary departure of money from these asset classes, because there is still liquidity in the system, right? The question is, will it come back? I think it will eventually. So really, if you look at it, if you're thinking US dollar is probably your best safe haven today, you may want to think again, because of the amount of money that's being created, and also savings rate today. Really, inflation is really an invisible tax that all of us don't face it. But really, if you put $100 in your bank today, and you don't invest it, and yes, you will still have $100 and a little bit after, say, 10 years, but you're going to be able to buy a lot less with that $100, right? Now, very quickly, if you look at interest rates, I think there have been a lot of say out there that interest rates may go up to 20%. I think it is very, very unlikely, because if you remember in the 80s why interest rates went to 20%, we have to remember it was the end of the era of the Vietnam War. It was end of the era of fiat money, right? Okay, so it might have fiat money as well, right? So if you remember why US increased interest rates 20% back then was because it was the beginning of the Bretton Woods system or the end of the Bretton Woods system, which means they needed to buy confidence as well. Now, when they did this 20% interest rate, that was really, really massive. And what happened was back then, you know, we were in a less globalized world, right? So today, if US increased interest 20%, I think it's very, very unlikely because they were trying to buy confidence back then in the US dollar. Historically, if you look at it, we'll probably peak maybe at 5%, which I still don't think we will. We'll probably land at a 2.5%, maybe 3%, right? That's probably where it is. So you can see it's actually a constant decline, not an increase, right? So of course, very quickly, I've just kind of summarized it for you. If you are looking for a hedge for inflation, really, if you look at commodity producers, right upstream would be your biggest hedge, right? And you know, I have a very quick summary of some of these who are listed on the SGX platform. These are some of the companies that are involved in the upstream business, right? Commodities. Now let's go into S-REITs very quickly. I'm not sure how much time I have. I think maybe 15 minutes. But quick run through right now. So really, part of inflation really affects REITs as well, right? If you look at REITs today, they are down on the index, I think well over 10% year to date, right? Which is very interesting now. So when you really want to look at REITs, there are four kind of things that you need to look at. What industry they sit in, where interest rates are or the direction of interest rates, what kind of dividend payout that you are getting, and of course, your debt profile as well. So if we look at the 10-year average spread, right, between interest rate and REITs, you're almost going to notice that every time they increase interest rate, your REIT yields actually go up. Okay, now they go up because prices come down. Every time there's an interest rate hike, you're going to realize that prices of REITs come down and therefore your yields go up, okay, to compensate for it. Now, so you can see this is from the SGX research. If you look at this period, whenever they increase interest rates, you're going to see that the index actually came down for during the taper tantrum. When they try and increase interest rate, you're going to notice that the REIT index actually dropped quite a fair bit, right? And that lasted about 8 months, right? The shortest one was in January, where it lasted about 4 months. And then you have another Fed rate hike again, 10 months. Now, where we're seeing now is actually 4 months into it. So if you kind of take an average, we might be looking at maybe 7-8 months of these downward prices. That means REIT prices actually have come down, right? Just like the whole market, which means when REIT prices come down, assuming it's a good REIT and it can still give you returns, your yields have actually gone up as well. Now, so what did well during COVID? What did really well, right? The industrial sector on REITs did really well. Data center for sure, I think it went through the roof, right? These were the two sectors that did really well. Warehousing, right? People were going online, Shopee and things like that. Now, what did really poorly, right? Holidays. No one could go on any holidays because we're all stuck at home. The retail sector did pretty badly, right? The office sector did pretty badly, right? Now, if we switch this around and we're looking at yields today, what we're likely seeing is that actually the retail and the hospitality sector will probably recover the fastest and will probably give you much better yields than they did in the last 2 years, right? So in reverse, right? So you must look at it from bottom up, right? And if you can look at some of these S-REITs today, Singapore REITs, right? A lot of them actually have increased, right? The retail footprint has increased. If you're in Malaysia, if you go to a shopping mall during the last long holiday we had, it was, retail is definitely back. In Asia, we somehow have this retail culture, right? Now, so if you look at most of the retail REITs today, if you look at that 1 year return, most of them are down, except for 2, right? Year to date, they're all down, right? Which is fantastic. As a value investor, it is fantastic. If you're looking for yields and you believe that this is only a temporary departure from the equity market and liquidity will come back, then you may have an opportunity in this space, right? Retail REITs. Hospitality as well. We're actually seeing yesterday Heathrow just announced that they are increasing their forecast for number of passengers, right, by 16%. So we're seeing that some of these recovery plays as well are starting to happen because people have been locked down for 2 years. They do want to travel. There is a lot of demand. So holiday areas, hospitality REITs who did really poorly in the last 2 years are likely to see even higher yields today. The fact that they've already come down so much and there is a recovery. So of course, if you get it at these low prices, then your actual yields could be even higher, right? Now, of course, if you look at most of the hospitality class compared to the retail, most of them are up, right? Most of them are up, highest being 20%. But generally, they're not as high, I would say. You're not looking at 30, 40, 50% kind of returns. Your highest is actually only 20, right? Now, but I for those of you who are interested in REITs, right? I just want to kind of share with you guys. So if you go to, we actually created a website for all anyone who wants to look at REITs or beyond REITs, for example. If you go to sg.equitiestracker.com, which is sg.equitiestracker.com, it's a free site. Just go there. We actually have these tools. So we actually have this thing called a REITs Guru, right? So if you want to find everything and anything about your REIT in a very detailed format, very quickly you can. So for example, right, we're looking at hospitality. So I'll click on this sector called hospitality, right? It'll show me all the REITs within this sector here as well. You can also look at the sector yield as well, right? So depending on which yield, if you look at retail right now, it's giving you on average the highest yield because prices have come down, right? Hospitality is giving you the lowest yield because it's historical yield, right? Not forward yield, right? Of course, you got data centers as well. So you can also look at the top 10 highest yield, top 10 highest REITs today. So probably if the prices have come down quite a fair bit, the yields have actually gone up. You can also use this website to track all your dividends as well. So if we just very quickly kind of look at, say, retail, for example, I can actually look at which are the retail REITs that give me the highest returns, right? So you say, look, this REIT gives me a 9.9%. If I click on it, I get a quick read on what this company does, right? Very quickly, I can see how much gearing there is, what's their occupancy rate, and how many properties they have, right? And then what the dividends are. And then, of course, you can also see, right? So see, these guys are actually located in New York, New Jersey, and others. So they are actually very much a retail REIT focused in the US, right? So you can see, if I click here, you can actually see where they are by location. You can also search by date if they've actually changed their locations as well. You can see that most of their retail, their revenue is from groceries and necessities, right? So very, very large chunk, right? So very stable. You can also see by segmentation where it's actually coming from as well. North Carolina, Florida, and so on. Now you can even deep dive into their actual property as well. And it'll give you, there'll be a picture here, right? It'll tell you where it is, what's the location, occupancy, it's 100%. So you can go fairly deep if you want to, right? If they have any car park lots as well. So we've actually created this website. Feel free to use it. Just go to sg.equitiestracker. You're going to find any information, not just on REITs, on stocks as well. So coming back to this, this is where. So if you're wondering where we get some of this data from, it's actually all there. You can browse through it yourself as well. No login. Just all you have to do is just use the site. Now, of course, one of the important factors that you must look at REITs is also the debt profile. Now, what is quite interesting is this, right? When we talk about S-REITs, the regulatory limit is actually only 50%. And you can see these are the 5 REITs with the lowest gearing ratios. Now, what does this mean for you as an investor? It means that if they do have opportunity, they can still gear up and buy more properties and potentially increase their yield. Now, of course, you must also be thinking, right? Look, I'm actually in a in rising interest rate environment. Won't this affect me, right? Now, the interesting thing about, hang on, let me just see if I can get that. I'm trying to find that slide. Now, the interesting thing about on this slide here, the interesting thing about S-REITs is that a lot of these REITs, 75% of the Singapore REITs, their debts are actually fixed rates, right? So increase in interest rates actually don't affect them. That means their interest costs would not increase, but if their business improves, then their yields are actually higher, right? So it doesn't negate some of the gains that you can actually have as well. Most of them are fairly lowly geared, or the 30 plus 35%, right? That's really where it's at. And if you look at the market today, the Straits Time Index year to date actually has gone up 3.3%, but REITs have actually gone down 5.5%. So for us value investors, we love what you call bottom fishing. Really look for prices that have actually come down quite a fair bit, right? And I think REITs today present that opportunity, right? As what we're seeing. Of course, if you guys want to look at the top 10 highest dividend yield, we've actually shared this PDF with you, so you could have it. It's actually all there, or alternatively, you can go to sg.equitiestracker.com. I think you can go by sector as well, which I've covered that. I think that's it from me. Of course, if you guys like our content, you like to educate yourself more and understand this a little bit better, feel free to follow us on any of our social media links, right? Thank you. Am I on time, Mark?
Oh, okay, thank you, Mr. Alvin, for your presentation. Yeah, actually you're on time, and actually if you have any points that you want to share further, still we got time. And let me see any questions so far. So far we don't have any question from the audience yet. Maybe they're still digesting those figures and facts that you shared. Okay, Mr. Alvin, just want to check with you, right? Since it's about REIT in Singapore, just to find out, for example, right now, people moving more to virtual, for example, like this webinar, let's say it's happening in a physical, in somewhere, possibility there is some growth, means the location will earn something, then the people will park the car, they will pay some coupons here and there, then the events maybe probably they have charges or something. So it means that there is some like economical growth and somewhere, and now everything's moved to like virtual. So how you look at this and REIT in Singapore? For example, now Singapore is open up their borders. Those who are working in Singapore now, they start to travel. Looks like, is it the demand will be still there, or will be give any impacts due to this virtual world?
I think I think you have a good point here. You realize one of the things that I did not cover or I avoided was actually office REITs. I think office REITs are questionable at this point in time, because I think post-pandemic things have changed, and we must accept that things have changed, right? However, leisure, when we talk about hospitality, when we talk about retail, I think there is no running away from leisure, because it's experiential, which means that you actually have to be on site. So I think that there is still that physical element that is needed. You know, you just give you guys an example. You know, we're trying to plan a conference this year, physical conference this year. We're just wondering, you know, we thought to ourselves, there should be a lot of space, right? And when we looked at some of these convention venues, they are actually already fully booked up to the end of this year, right?
Agree.
So I think when it comes to leisure or anything that is experiential, you know, somehow this virtual world that we're in still can't replace it, right? But when we talk about office, you know, dedicated office where you get people to come in and actually work, I think that is a bit iffy, right? I'm not so certain of that. Yeah.
Okay, good. Okay, there is one question from the Mr. I think Chan. Okay, what's the future of retail rates?
I think it has to be geographical. If you're asking me that question, I think if your REIT is very much, I won't say localized, but very much within the Asian region, or maybe Southeast Asia region, because in the world, in the West, retail is dead. Absolutely right. It's a slow death. It's dying a slow death. Already dead, right? So I think if you're in that Western space, I think retail REITs are challenging unless you talk about grocery stores, right? Which is kind of everyday things, right?
Okay.
But I think in Asia in particular, we talk about China, you talk about Southeast Asia, Indonesia, Singapore, Japan, these places, I think it's still very much cultural, right? That retail cultural, right? Like I said earlier, it's experiential versus doing it online, right?
Okay.
Very easy to see. You just, the best thing, the easiest way to research REITs, right, is actually where their location is, so you can actually walk in there and look at foot traffic, right? I think that's a great kind of indicator as well.
Okay, good. Okay, then one more question from Lung. Which one is the best performance REITs, REITs in Singapore in terms of growth and stable dividends?
Yeah, unfortunately, that fall under financial advice.
Yeah, yes.
I mentioned, that's something that I would prefer to avoid addressing. But I suggest you can go to sg.equitiestracker.com. You can find the highest yield, right? And you can use that site to actually figure out which has been fairly consistent, right? Look, I think all REITs are consistent. So I think consistency is granted because these are collateralized fixed income instruments, right? So REITs are collateralized fixed income instruments. That means they give you fixed return every month, right? Or every year or every quarter, or whatever it is, right? And it's collateralized by property. So it's a hybrid fixed income instrument.
Yeah. Alvin, got one more question. I think it's quite interesting from Alan Tan, which is, will you recommend single REIT stock or put your money into a REIT funds instead to diversify the risk?
I think depends how much time you have. Because if you have time to actually do it yourself, so actually the way that the question is, should I do it myself or should I get someone to do it for me?
Someone to do
right?
it, yes.
I think that's a very personal question. So if you have time to do it yourself, right, then yeah, you can do it yourself. But if you don't have the time to do it yourself, then get someone to do it for you, right? Of course, you will pay a fee and you should expect slightly lower returns because of that fee, right? But you're paying for convenience. So
yeah. Okay, let me see. Is there any other question? I think that's all for today, Mr. Alvin. I think no more questions. So once again, thanks again for Mr. Alvin for helping to do a presentation and also addressing our participants' doubt. So to all our participants, feel free to drop an email to investhelp.my@fundsupermart.com. So if there is any questions on this topic today, so we will get back to you. And I believe one of our colleagues will already share the link that you're able to go to view the equity tracker and use to it for your investment as an investment tools. Okay, so with that we come to end of our event today. Okay, so there is several upcoming events, webinars with different topics. So you may visit our website, FSM1 website, and get more details and register online. Okay, once again, ladies and gentlemen, we hope this session added value tools to your investment decisions and your investment journey. Thank you, everyone. Thank you, Mr. Alvin, again.
Thank you
for your time.
Bye-bye.
Bye.